Have you ever wondered how a trade war with the United States and a surge in new apartment constructions could impact the Canadian multifamily real estate market? Welcome to the Multifamily Real Estate Insights podcast. I am your host, Sandy MacKay. Let's get right to it. According to a recent report from Oxford Economics, the Canadian multifamily market is currently facing challenges due to a combination of increased supply and international trade tensions. The report highlights that the average national asking rent in Canada was $2,129 per month in May, marking a 3.3% decrease compared to the same month last year. The cities of Calgary, Vancouver, and Toronto have seen the most significant declines in apartment rent over the past year. The completion of new multifamily units has surged, with a 35% increase in 2024, rapidly contributing to the country's overall supply. Oxford Economics anticipates this trend will continue as a record number of purpose-built rental units are completed and integrated into the existing stock. Despite the increased supply, the demand for rentals may be tempered by slower immigration and fewer temporary residents. However, the ongoing challenges in home ownership affordability and the financial strain on households amid a trade war-induced recession are expected to sustain rental demand in the near term. On the international stage, tensions between Canada and the United States have been escalating, particularly concerning tariffs. The United States, under President Donald Trump, has threatened to intensify the trade war unless Canada retracts its digital service tax targeting American tech giants. In response, Canadian Prime Minister Mark Carney's government has agreed to resume negotiations, with hopes of reaching a deal by July 21st. Yet, there is no guarantee that an agreement will be reached. Tony Stillo, Director of Canadian Economics at Oxford Economics, has expressed concerns that unless a deal is struck to remove most U.S.-Canada tariffs, the housing slump is likely to persist through the end of 2025. Stillo predicts that the resale housing market will struggle to recover due to poor affordability, weak confidence, and job losses stemming from the recession. Additionally, a reduction in immigration will further burden the sector, potentially pushing up the supply of homes for sale and causing average prices to drop by 8% to 10% by the end of 2025. Despite these challenges, there are signs of rebalancing within the multifamily market. CoStar Market Analytics notes that market vacancy rates are approaching more balanced levels in highly unaffordable urban areas like Toronto and Vancouver, while moving towards cyclical highs in Alberta. This could offer a silver lining as the market adjusts to the current conditions. Multifamily housing construction has been a hot topic lately, especially when it comes to its impact on affordability. A recent article by Charles Gran titled Multifamily Housing Construction and the Affordability Escalator delves into this very issue. The debate often revolves around whether approving high-end developments truly addresses the affordable housing crisis or simply exacerbates it. The argument against such projects is that they seem to cater to upscale markets, potentially sidelining the needs of lower-income communities. At the recent Dallas Housing Coalition's second annual Housing Summit, Alex Horowitz, a project director for housing policy at the Pew Charitable Trusts, presented an interesting perspective. He suggested that even luxury multifamily developments could contribute positively to housing affordability. According to Horowitz, the concept of housing as an escalator is key. When more high-end units become available, it allows higher-income renters to move up, thereby freeing up middle-income housing for others. This mobility down the rent ladder could potentially help alleviate pressure on lower-income housing as well. Horowitz supported his claims with data from the Pew Charitable Trusts and research by University of Notre Dame economist Evan Mast. Their findings indicated that for every 100 apartments built in affluent neighborhoods, around 40 to 70 units become available in lower-income areas. This chain reaction, often referred to as the affordability escalator, suggests that increasing the overall housing stock, even at the luxury level, might ease rent pressures across different income levels. The discussion at the summit also touched on the importance of land use deregulation to combat housing shortages. Horowitz highlighted Raleigh, North Carolina as a successful example. The city implemented strong local land use reforms in 2021 and 2022, leading to a surge in housing production. This included the development of more affordable housing options like apartments near transit, accessory dwelling units, duplexes, and townhouses. As a result, Raleigh experienced a slowdown in rent growth, showcasing the potential benefits of such reforms. However, not everyone is on board with these changes. In cities like Dallas, there are concerns about the impact of rezoning applications and parking reforms on single-family neighborhoods. Critics worry about increased crime, traffic congestion, and the loss of neighborhood character. Despite these concerns, the build baby build mentality continues to gain traction among officials looking to address the housing crisis. Moving on to our third segment, let's dive into the Canada Real Estate Market Outlook 2025, according to CBRE. This comprehensive report provides insights into what we can expect in the coming year across various sectors of the real estate market. Despite some challenges, Canada remains a beacon of growth, ranking among the top G7 nations in gross domestic product, population, and employment growth over the next 5 years. These factors are closely tied to the demand for all types of commercial real estate, and 2025 is set to see increased activity. The report highlights that the cost of capital crisis, which has been a significant concern, is expected to ease. This could lead to a boost in investment and leasing activities. While leasing fundamentals are improving, it's important to note the substantial new supply in the office, industrial, and residential sectors that will take time to absorb. Mark Meehan, Managing Director of CBRE Research, emphasizes that these conditions position Canada well for success in 2025. Let's break down some of the key insights from the report, starting with the economy. Despite a slight dip in economic growth forecasts due to immigration restrictions, Canada's long-term outlook remains robust compared to other G7 nations, which bodes well for commercial real estate demand. In the capital markets, we're seeing an uptick in sentiment and stronger investment activity anticipated in 2025. Cap rates for certain asset classes may start to compress depending on global bond market conditions. In the debt markets, availability is expected to improve, although lenders will continue to be selective. As credit spread dynamics begin to normalize, loan underwriting will reflect broader market trends, particularly in terms of rents and vacancy rates. In the office sector, occupiers are shifting back into a growth mindset, paving the way for recovery. The focus on flight to experience and a slowdown in new supply will likely result in an undersupply of modern, amenitized, and environmentally sustainable buildings. The retail sector is also showing positive signs with leasing intentions on the rise. However, the supply-constrained retail landscape is pushing retailers to consider expanding into secondary markets and altering the scale and format of their stores. In the industrial sector, we're seeing some headwinds due to softer demand and an influx of new supply. However, the market is working towards normalization, which could happen sooner than expected. Finally, let's focus on the multifamily sector. While immigration curbs and new supply deliveries have created some near-term uncertainties, the long-term growth fundamentals remain strong. This presents a compelling investment thesis despite the current challenges. It's essential to keep an eye on these dynamics as we move into 2025. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.